Welcome to Alpha Recap, your quick, clear take on the trading day. I'm glad you could join us. As always, if you have questions, you can reach us at stockalpha.ai and ask away.
Thanks for having me. Great to be here.
All right, Jessica, let's jump in. The big picture. Markets closed down across the board today, led by a tech-heavy sell-off. But, walk us through the headline numbers.
Sure. The S&P 500 finished the day down about 1.5%. The Nasdaq 100, the tech-heavy index, plunged, finishing down about 3.3%. And small caps, measured by the Russell 2000, closed down roughly 1%. So it was a concentrated hit in big growth and momentum names that spilled into the broader market.
And the Nasdaq 100 really took the brunt of it. That was a pretty sizable move for the index.
Yeah, that tracks. It was one of the larger single-session drops for that index this year, and it reflected a combination of profit-taking, headline risk, and a pullback in richly valued growth stocks.
So, what really stands out here is the why. What drove traders to pull back from those names?
Three main things drove today's action. First, profit-taking in mega-cap tech and momentum stocks accelerated. Traders de-risked carry and valuation exposure. Second, legal and policy headlines created some idiosyncratic winners and losers. A couple of Supreme Court decisions landed in ways that changed sector sentiment. And third, we saw a rotation into more defensive and commodity-linked pockets: energy, utilities, parts of materials, and industrials, as participants sought lower beta or cash flow-oriented exposure.
Hold on, that Supreme Court news? Really? What happened there?
Yeah. One ruling was interpreted as favorable for a big energy company. It eased a legal overhang and helped that sector outperform. Another ruling essentially cleared the way for the end of litigation for a major networking equipment firm, which removed a specific overhang for that space. Those decisions created winners in energy and eased pressure on parts of technology, while broader tech and AI-related names still sold off because of the concentrated profit-taking.
Interesting. So while tech sold off, energy actually held up.
Exactly. Energy was a bright spot. Utilities also attracted buying. Investors liked the lower volatility and cash flow stories tied to storage and microgrid companies. Materials and mining names tied to rare earths and domestic supply chain initiatives picked up some interest too. The tech and communication services complex was the epicenter. Large-cap software, AI chip-related names, and ad tech led the declines. Momentum indexes and ETFs underperformed across the board.
Which connects to the pull on consumer discretionary, right?
Right. And the other thing is consumer discretionary weakened alongside tech. Retailers and discretionary names tied to online ad spend felt the pain because ad cycles and tech demand are linked. Financials were mixed. Some banks showed caution given interest rate sensitivity, but banks with stronger funding profiles or energy lending exposure held up better.
Short reaction. Wow. Big day.
Not ideal.
Let's zoom out to the macro and Fed picture. No huge CPI or jobs prints today, but the market reaction had Fed implications. Explain that for listeners.
Sure. Even without a big macro shock, a large revaluation of growth assets effectively tightens financial conditions. When equity prices fall, wealth effects and margin dynamics can reduce risk appetite. Analysts note that this repricing increases the odds that markets will tolerate higher rates for longer because easier financial conditions have been part of what supported high growth valuations. So if risk assets repriced further, it could make it harder for markets to assume downshifts in policy.
Put simply, when growth stocks drop a lot, it can act like a rate hike for markets.
Exactly. It's not literally a policy move, but it squeezes liquidity. Traders will be watching yield curves, credit spreads, and any Fed speaker comments closely. If inflation surprises to the upside or the Fed stays hawkish in tone, That could amplify the move.
I mean, when you step back and look at this, it sounds like a volatility flag for the near term.
Honestly, I was a bit surprised by how concentrated the selling was. Concentration increases headline volatility. Breadth deteriorated because the heaviest weighted growth names did most of the damage. That's why the Nasdaq 100 dropped more than the S&P 500, and why the Russell 2000 only fell about 1%.
Quick technical read. What should listeners watch on the charts?
From a technical standpoint, watch near-term support levels on the S&P 500, those recently tested moving averages, and monitor the Nasdaq for potential oversold bounces or continued distribution. Momentum indicators flipped negative, but oversold conditions can lead to short covers and sharp intra-week rallies. So breadth and sector leadership in the next few sessions will matter a lot.
Short reaction. All right, beyond the sector flow and macro, any individual names or themes that stood out?
Yes, we saw mega-cap tech and AI leaders account for much of the Nasdaq weakness. Energy benefited from that favorable court ruling and commodity strength. The networking company that got legal clearance saw relief. Healthcare was mixed. Some defensive biopharma names drew interest after comments about international drug innovation. Utilities tied to storage and microgrids were bid. And materials and mining, tied to rare earths, got analyst attention amid domestic supply chain policy talk.
A day of winners and losers, driven by law and sentiment. Fascinating.
It really highlights how legal and policy headlines can create idiosyncratic moves, even when the broader theme is a risk-off rotation.
So what should traders and watchers keep their eyes on ahead of the next session?
Key things to watch: Fed speakers and their tone, upcoming economic releases like PMIs, durable goods, and weekly jobless claims, any earnings or guidance from tech, semiconductors, and big retailers. Second-half commentary matters. Further legal or policy developments, especially in energy and telecoms, and ETF flows into defensives versus outflows from growth. Large flows can amplify moves and tell you whether this was a short de-risking or a persistent rotation.
Got it. Historical context. Is this pattern familiar?
Yes. Historically, concentrated sell-offs in the heaviest growth names have preceded periods when leadership rotates toward value, cyclicals, or defensive income streams. If this rotation persists, flows could accelerate into energy, materials, and utilities, sectors tied more directly to cash flows and commodities. Conversely, a quick stabilization in earnings outlooks or supportive macro prints could spark a relief rally back into technology.
Short reaction.
Yep, timing matters.
Before we wrap, let's give listeners 3 quick takeaways.
1. The market closed the day with a tech-led risk-off tone. The Nasdaq 100 dropped about 3.3% and pulled broader indexes lower. 2. Legal and policy headlines reshaped sector outcomes. Energy and some defensives outperformed amid rulings that removed certain overhangs. 3. The repricing has Fed relevance. Analysts note it tightens financial conditions and keeps volatility elevated until clearer macro or policy signals arrive.
Perfect. Quick reminder, this episode is for information only. We're not giving investment advice or recommending any buy or sell actions. Analysts' commentary reflects market observations, not personal advice.
Correct. This is market color and context, not a recommendation to buy, sell, or hold any security. Use it to inform your own research.
Thanks, Jessica. That wraps up today's Alpha Recap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks, everyone. See you next time.